So due diligence is one of the most important aspects of evaluating a deal. And for many family offices, they do not have the expertise in-house with the personnel or the ability to evaluate real estate opportunities. And because of this, family offices could see the outcomes coming back different during a downturn in the market or upon the sale of an investment that they invested into. Today, we have Bryan Mick of Mick & Associates in Omaha. It's a law firm that focuses on due diligence for broker-dealers, RIAs, and the family office space. Bryan, thanks for being on the show.
DJ, it's a pleasure. Nice to see you again.
Nice to see you as well, Bryan. So a lot of times families don't have the infrastructure in order to do the proper due diligence. What's the biggest thing that you see when it comes to due diligence that is often overlooked?
It's generally the underwriting piece of it. I think the family office side, and frankly, other folks in the industry, whether it's on the RIA, BD, or independent, high net worth investor, is really doing the analysis of, the Moody's economy.com state analysis down to the MSA, down to the submarket, down to the competition, and it takes a lot of tools and experience to really underwrite the deal relative to the prospective valuation.
Now, one of the things that I talk about often is the importance of underwriting the sponsor first and foremost, because I say that the deal is secondary to the sponsor, because if you don't have somebody that's going to be implementing the strategy, the deal is really secondary. What is your thoughts along those lines, and what has been your experience with the underwriting of sponsors that's been favorable or unfavorable?
I agree with you, DJ. When somebody comes to our firm or is referred to our firm by a family office or an RIA, the first order of business, if they're coming to a new segment, if you will, of capital sourcing, is to get that sponsor legal opinion done. And that process takes a good 30 days to do it right. We have a checklist that's as long as your arm, and we are highlighting all the different functional areas. So accounting procedures, IT security, investor reporting, tax reporting. We are looking at, a lot of people promote their prior performance. What does that mean? That means pulling actual files and looking at closing statements and redacted checks on a sample basis anyway. We do the on-site meetings, of course. We've got 17 databases that research 5% shareholders, officers, directors. Then we're going to obviously take a look at prior offering documents and understand the front end structure and economics and the waterfall structure and that kind of thing. But the nice thing is once that's done, generally speaking, our clients don't ask us to revisit the issue. There are some asset classes that get attention generally from a negative perspective, where our clients will ask us to go back in, if you will, on an annual basis. For instance, the conservation-oriented real estate deals that are getting a lot of attention from the regulatory side. So our clients will ask us to do kind of a normal cycle update, if you will.
Fantastic. And what's the biggest thing that you come across that is a immediate red flag when you are looking at these sponsors?
Well, the easiest, I won't say the most common, but probably the easiest disqualifying factor would be anything from the background side. And we have to kind of bifurcate what that means, because under the federal securities laws, there's well-established case law on what materiality might be, and then there's also the statutory side where like the recent, or I shouldn't say recent, 4 years ago or so, SEC bad actor rule was implemented. So there could be something in the background of one of the principals that isn't necessarily required to be disclosed in an offering document or in an LLC agreement that you're structuring for a single investor, but nevertheless could be material. If you have a CFO of your company, it was CFO of 2 other companies prior that filed bankruptcy, that's not a disclosable item in the offering document, but it's something that the client might want to know. So it's, obviously tax liens, fraud, bankruptcies, all that kind of stuff. And we understand, I mean, listen, we went through the Great Recession. The Great Recession took out General Growth Properties, one of the largest mall owners in the country, took out Tishman Speyer out of New York, and some other folks that were, quality, longtime real estate operators. So we understand that there may be a hiccup or two, but oftentimes you see a pattern in practice, and obviously that's red flag number one.
Well, a lot of people think that the larger companies, just like you had mentioned, that there's really no need to go through the due diligence for the sponsor because they are a large company, right? And you look back during the downturn, and there was Lehman, which is amongst others that went down, and you named a few of those as well. Also, even some of the easiest things that people can do on their own, which is a Google search, isn't even done. Sometimes things come up from something as simple as that, let alone be as comprehensive as what you're talking about. Now, on the deal side, family offices, the majority of family offices like to do direct deals into real estate. What are the areas that are typically overlooked on the deal side, and what should they be looking for?
On the deal side, and I guess it depends whether it's an active or a passive investment approach. I mean, obviously, if it's a more active investment approach, an active investment approach usually corresponds with a significant amount or all of the capital being sourced with one family. Then you're really in more of a co-GP type of relationship where you're approving certain expenditures, you're approving, budgets, you have access to the checking account, at least to log in and see what's happening if nothing else. That's one structure that, if you're putting a significant amount of the dollars in the deal, then you should be pushing for all those controls. On a more passive basis, you're still going to want quarterly financial reporting and progress, project update type information. In terms of the structure of the deal, I used to, when I was in-house at the Werner boutique BD, which was essentially a family office, I asked 3 questions. Who's putting money in? Who's taking money out? And is the compensation success-based? And those seem real simple, and there's a lot of sub-questions that go along with that basic analysis, but that'll help ferret out about 80% of the deals.
And down at the project level, also looking into deeper, the deeper parts of due diligence, such as the financial models, right? What are the assumptions that they're making? What is the market like? Can you go into a little detail about that? Sure.
So we utilize maybe some traditional database information. So we use Reese, we use CoStar. If it's a hospitality project, we'll get the STAR report. If it's a specialized asset outside the 4 food groups, we'll go for, storage, for instance, we'll go to, or NIC for the senior living, we'll go to those industry type organizations for the data. Sometimes it's a brokerage firm that might specialize. Like, for instance, triple net deals. We use a lot of information from the Boulder Group out of Chicago. They're very well respected in the triple net space. So you have to do that research, and then, as I talked about before, kind of the Moody's and the Reese market research, but then you really have to dig down into that submarket and the asset class. So you utilize those databases and sources of information, And then what's nice about, our underwriters, because of their day jobs, if you will, they've got finance and brokerage contacts throughout the country, so they can drill down a little deeper. But you're looking at occupancies, obviously. You're looking at lease rates, construction, TI costs, all of the parameters that you would normally try to analyze, within a small radius of where your project's located.
I have to believe that with the number of years that you've been doing this, the number of projects that you've looked at, that you've actually sort of, should we say, kicked out of the system opportunities for people to actually invest into. Family office is more and more sort of starting to get on the bandwagon, understanding that there is some due diligence that maybe needs to be done, but still there's a tremendous amount that aren't taking these necessary steps. Do you have any examples of this that's you guys identified a deal that was, let's say, a lackluster or not what people thought?
One of the problems, and it's the refreshing thing about the family office investor, is that person or entity is generally a bit more patient. They understand how to play long ball. In the broker-dealer world, there seems to be more of a focus on cash flow and a monthly check. So when you focus on cash flow and a monthly check, that can lead to bad structuring decisions, and it can also lead to some investor abuse. One glaring example is your typical non-traded REIT. When you pay out distributions and the underlying portfolio of assets does not create the cash flow to pay those distributions, that generally creates a drag on performance. We've also seen in the triple net space where folks utilize interest-only financing. You mentioned a couple of those large New York firms. There is another New York firm who promotes a lot of real estate projects, and we looked at a Walgreens portfolio, DST, offering with interest-only financing. That's just ludicrous. You're playing with fire. And going back to the reach, the Holy Grail was always reaching their FFO or MFFO, however you want to define it, their cash flow coverage number. And the way they did that was utilizing LIBOR, floating rate debt, LIBOR plus financing, which when the front end of the yield curve was moving down with everything else, that worked out just great. But it hasn't worked so well the last year or so. So financing tricks, and then, affiliate transactions are always a sore spot for us. The other thing about we're seeing more, what's refreshing is we're seeing more folks today, firms that are realizing the power and the patience of the family office and registered investment advisor dollar. And they're coming over from the institutional side. And when they come over from the institutional side, they come with an institutional structure. And that makes our job a lot easier, frankly.
Yeah, but one of the things that you brought up was the financing. Obviously, the floating rate, if you got that variable, can make a huge difference, especially if we start seeing the rise of interest rates, et cetera. But on the interest-only perspective, if they're looking to get cash flow, aren't they going to maximize the cash flow that's coming, to the investor? I mean, what is wrong with that? Why is that a bad thing to do?
Well, all I know is that the developers that have raised me have generally said, listen, if you're going to own a piece of real estate for an extended period of time, and whatever that time frame is, 8, 10, 15, 30 years, you want to fix your debt for as long as you can.
Sure.
Now, we were talking in the long-term hold triple net space, right? There are obviously situations where IO debt makes sense. Construction, value add, rehab, turn type strategies where you're in and out in a period of 3 or 4 years, understandable.
Right. I gotcha. So, do you have any current deals, whether it's in real estate or other markets, that you've currently identified that wasn't what it seemed to be on a deal perspective?
We had just yesterday, we finished up our opinion on a oil and gas drilling and working interest fund, and sadly, it was already funded to about $170 million with high net worth and family office money, and it's not going to work out very well.
Really?
Yeah.
That's going to be definitely going to be a lesson learned. I think that also, family offices in a recent study that was done by the Family Office Real Estate Magazine shows that family offices aren't participating in the crowdfunding space. However, to me, it seems that once we hit a downturn, there's going to be quite a realization, I think, with a lot of these high net worth investors that have been investing in the crowd street because maybe the deals weren't scrutinized enough, underwritten enough, and all boats rise in a rising tide. And so when we do see a downturn, maybe not the upcoming downturn that should be a short-lived, but when we hit into a recession, I think we're going to see quite a number of people that are going after these crowdfunding sites or actually going after these sponsors.
Yeah, I couldn't agree with you more. I'm tired of seeing the latest email spam from Realty Mogul on the third position mezz debt on the nicest trailer park. There's other situations like Rich Uncle's REIT. They say, well, no acquisition fee, no disposition fee, no management fee, or asset management anyway. Mm-hmm. Well, guess what? The back end split, the carry's 40%, not 15% like we usually see. So, not all is as it seems, and there are a number of the crowdfunding general solicitation portals that don't do any due diligence. They say they do, but I've seen them.
Which leads me to another question is that, I'll be in the car, I'll be listening to Sirius radio and certain news networks or whatnot. And I hear about these investment opportunities with real estate where they're talking about, they use the word guaranteed, and they use that multiple times. I know that we've had regulations that's come through in the last number of years that allows for public advertising, but how are they able to get away with that? Or is that something you think that the SEC or the FINRA is starting to take a look at?
I think both those regulatory bodies are definitely focused on that. I mean, that the word guarantee is that's unacceptable from a regulatory perspective.
Right, exactly. So is there anything that you would, that you would suggest to families that might not have that infrastructure in place to do the due diligence that they, the key thing that they should be looking for when they're approaching an opportunity to possibly invest into?
Well, family offices come in, obviously, and you know more about this than I do, all different sizes and shapes and levels of sophistication. But I contend that unless you're managing, $1 billion or $2 billion and you can afford an internal team, it's very difficult for a family office to have a real estate lawyer, a real estate underwriter, a private equity analyst, a life settlements expert, an oil and gas lawyer, a petroleum engineer, a geologist, and on and on and on, equipment leasing analyst, all on staff. So in case something comes in that they might be interested in taking a look at, it's highly unlikely that they're going to have the broad in-house expertise. And that's really, an important point to make here is if the family office has a chief investment officer that's supposed to be screening or doing the A to Z due diligence on these deals, we are not replacing that person. We're the bench. We're the sixth man. We're the go-to to help with that process. So we like to see it as a collaborative relationship. And I know, listen, if you are a family office and you created your wealth through commercial real estate development, I'm not the person to say you can't handle that. I think that would be ludicrous. But or if you were in the midstream or upstream, oil and gas space for decades, you're going to know that product. But once you get outside of that narrow strike zone that made you successful, you need help, and that's what we're here for.
Yeah, if you did create your wealth in real estate, you do have all the infrastructure in place, and probably even more so from that. So we see that we believe that there's going to be a downturn that's going to be coming. Could be in the next 9 months, 12 months, etc. Do you have any comments? Looking forward over the next year or two that you think will be coming around the corner, or that could be some red flags, maybe?
Yeah, generally speaking, we've been advising our clients for a while now. Just don't be the last common dollar in a quote unquote stabilized deal. The way, in my opinion, you can't just get out of the market. That's folly, because if you analogize it to the public equities markets, plenty of people got out when they thought that the Dow was outrageously valued at 19.5. So if you're in real estate, or if you're in energy or whatever, you can't just say, hey, things are crazy, I'm out, and sit on the sidelines for a period of time. You need to rethink the investment focus and the part of the capital stack that you want to be in. So don't be the common dollar or the last common equity dollar in a quote unquote stabilized deal. Think preferred equity, think mezz debt, think development. Get into a situation where somebody else's dollar is behind yours. I think that's the first piece of advice. And then the second is, watch the financing. It's kind of like FHA has now approved a program whereby a bank lender can actually loan the 3.5% that's required to buy a house and put it on a second mortgage. That's ridiculous. So on the financing side in the commercial space, drop that LTV, get a longer commitment. You don't want a construction mini perm that terms out in 4 years or 5 years. You might want to look at a forward commitment and paying the premium that it takes to get there and lock down your debt for a longer period of time.
Great. Well, Bryan, thanks for being on the show today. We appreciate it. Due diligence is a big area that family offices do need to understand more and more. And so we appreciate you having on the show.
Thank you very much, DJ.
Next, stay tuned for the next topic that we're going to have on the Family Office News Network. And we're going to go into some areas, which is some other asset classes that you might want to take a look at.